All right, here we are, sir. Hey, everybody, Mike Lawson here with CU Broadcast. Welcome back to our show. Oh, wait a minute. Let me turn down Tom Glatt's walk-up music. Hang on.
That's right.
Hang on a second here.
My dance-up music.
That's right. All right. Hey, we are here back again, CU Broadcast, and our good friend Tom Glatt from Glatt Consulting is with us live on CU Broadcast. And great to have you back, Tom. As always, we invite you back every quarter to give us the latest Credit Union Industry HealthScore update. And this time, we got some more interesting news this time around because we're going to be talking about, obviously, all the stats and the performance as we usually do. But there's a little bit of a Silicon Valley Bank fallout as well. So, and we'll have some charts and graphs and things like that to show you as well. So with that said, sir, what's the latest going on with the latest Credit Union HealthScore these days?
Yeah, let's get into it.
Sure.
I do like the idea of dance-up music, though. So,
you like that? I can play it all day long, man.
Yeah, I like it.
It's right there. It's all day long.
And it would just add additional creative context for baseball if baseball players danced up to the music they chose.
Exactly. And who doesn't want that?
Yeah, that's a good question. All right, yeah. So the health score, where are we at? As you know, the score runs from basically 0 to 10, 0 being not so healthy, 10 being healthy. So that's our score scale.
Yep.
And right now, the industry has a score of 6.208, which if you think about the distribution of our score when we created the model, 5 indicates historically average health. When we looked at it, the health and performance of credit unions, historically speaking, and we set the model, 5 is that average benchmark level. So, you look at that and you go, hey, the industry is above average. So that's certainly good news. But I think you have a chart for me that shows.
Yeah, I think it's this one.
Yeah.
Is this the one, sir?
This is it. So this particular chart is the percent change year over year. And I always tell people I like to look year over year in comparing credit union health and performance because credit unions have a lot of seasonality in their performance data. We've got holiday spending and summer vacations and taxes in the spring and what have you. So looking year over year allows us to kind of get a sense of how things are performing, comparing like periods as best we can compare like periods. And we've got that weird COVID steeple in the middle of that right-hand side there. But the point of the chart here is that anything below that 0 line is declining performance. So since 2022, we've seen that health score below the 0 line, meaning year over year declines in performance. So we've been above average, but we've been pulling back to the average for quite some time. As a matter of fact, what did I say? 4 straight quarters. So my suspicion would be that, all things coming back to averages, we'll see that turn a little bit there.
Well, it looks like there's a little bit of an uptick right there toward the very end right there on the far right.
Uptick, but still a decline.
Yeah, we're still under. Yeah. Okay.
Yeah. So it's the year over year percent change is only to negative 0.34. The prior quarter was negative 1.26, and prior to that was 1.7. So we're slowing the rate of decline, though it's still declining, but I think that'll moderate.
Okay, cool. So, and you wrote, and accompanying all the performance stats and things like that, you always write a kind of a health score post as well. And in this recent post, you shared some kind of like Silicon Valley Bank fallout of that debacle. So you want to share some of the effects that may have had on the industry, or based on the recent score, or did it even have an effect on credit unions? I know it did on the banking industry, but credit unions, did it really have any effect?
It has certainly had an effect on the media. So they,
of course. Oh my gosh.
Nothing like a good bank failure to spark interest in media professionals like yourself.
Yes, sir.
I'm not sure that it affected anything in credit unions other than credit unions had to be a little proactive in creating some messaging about safety and soundness. I'll give you one example. I was at a client's annual meeting about a month ago, and they were making the distinction between their membership type versus the customer base of Silicon Valley Bank. And they were saying, Silicon Valley Bank had 94% of their deposits uninsured. And this credit union was telling their membership that in contrast, they had 95% of their deposits insured. So I don't think we have that same kind of abundance of uninsured deposit risk that SVB had that was the market was able to manipulate through social media posts and the like. But we do have an interesting trend going on in the credit union space. So in our score model, we have something called cash and short-term investments to total assets, and it's a liquidity metric. It's a measure of how much liquid assets, liquid cash we have that we can use either to pay depositors the money when they come in, or it's money we can loan out. So I think you have a chart for me there.
I do, sir. Here we go, right here.
Yeah, so this is the raw score, not year over year percent change. And for a long time, we've been operating with a much higher level of cash relative to assets than we have for quite in compared to history.
Yeah.
But that right-hand side, you can see that incredible decline. And I'm counting the numbers up here. 1, 2, 3, 4, 5, 6, 7. 7 straight quarters of year over year decline in the score for cash and short-term investments to assets. So part of that was that incredible growth we had in assets as a consequence of stimulus. But really, you're seeing credit unions putting more and more cash to work in two ways. One is in investments and the other is in loans. So we've seen a lot of loan growth happening as a kind of post-COVID unleashing of our economy, to the point where we're seeing, inflation and all that good stuff.
Okay.
Not good stuff, but all that stuff. But really, credit unions have been putting cash to work at the same time that asset growth has been going down. So if cash and short-term investments is in relation to assets, we're seeing that we have much less cash relative to our assets. Is that a liquidity problem? Not necessarily, but this is where credit unions have to think strategy. Do we need to temper loan growth a little bit? Well, we've got great scores in loan growth. That's contributing to sort of that slowing down of our decline in our health score. If we slow loan growth, what effect does that have on our member relationships? So that's why it's a strategy question.
Okay.
If we temper loan growth by tightening standards, what does that do to people who are maybe trying to refinance loans that they have? Does it exacerbate problems with credit quality?
Yeah.
But we're definitely seeing tightening in the cash position. The other thing that we've seen, and I think this is, I'd have to dig into the detail to see who specifically has a problem here. But there are credit unions, when the yields were so low, that took cash and short-term investments because they didn't have loan growth, and they went really long in their investment horizon. So you do have some credit unions that probably have similar types of balance sheet risks that Silicon Valley Bank did, but without that uninsured share dynamic that would cause a panic run on the bank.
Right. Yeah. Some very interesting times indeed, sir. And so what other stats do you have for us? Because you are laden with performance stats, Tom, because of all the data that you have there. And it's always, so up to date. Anything else to share with us as far as performance stats that we should know, that should we be aware of? And then also, I always enjoy you always provide a couple of credit union examples as well of who's doing what and who's doing not so what. So, yeah. So you got any of that information for us?
Yeah, I certainly do. Like I said, the cash and short-term investment's been declining in the same fashion that asset growth has, because they do kind of move a bit in lockstep. So we've definitely seen some, that runoff of all that asset growth that we saw over COVID. So what's interesting there is, how do you get it back if you need deposits to fund loan growth? And the challenge there is the pricing strategy. So you've seen the news. Apple came out finally with their little deposit product yesterday, their partnership with Goldman Sachs, and it's over 4%. And it's easy to access, right? So the question there is, do we see some pressure on our earnings side, which we've seen a relief of the last quarter, if we start having to compete on higher deposit rates real aggressively to kind of stem the flow of asset growth outflow. So that's one thing that I'd be paying attention to, because we had 2 quarters of decline in return on assets, and then we came kind of roaring back, if you will, with a year over year percent change of 2.22. So that's really good. But here's one thing that I would really be thinking about at this point. I think you have a chart for me here. So delinquency and charge-off numbers.
Here we go, right here.
Yeah. So this is the raw score. And again, you think about 5 being the average. So we've had very good scores for delinquency and charge-off. And for the viewing audience, in the scoring system, remember, 10 is more healthy, 0 is less healthy. It's not like the delinquency and charge-off ratio itself, where higher is worse in a sense. So what we've seen really is, this chart shows, is that really low risk in our portfolios that we've experienced over the last few years since COVID, with all the stimulus money coming in.
Mm-hmm.
We're seeing that turn, both the charge-off line, which is red, and the delinquency line, which is blue, crested around 8 and a little over 7.5 respectively, but they're going down, and this is likely to moderate to the average. And what that means is that's a lot of delinquency and charge-off to catch up with. So if we do have consistent high prices, we have consistent high rates, people can't refinance and roll over debt, you are absolutely likely to see delinquencies and charge-offs come down to that average metric.
So it'll be, coming back down to like the 6 area, I'm assuming. So
if we're lucky, probably more down to, probably a little below 6. I would say probably like in that 2005 timeframe on the left-hand side, we would have seasonal pops and charge-offs.
Yep.
But look at where the blue is on the left, the delinquencies. I'm sure that's where delinquencies will end up.
Okay. Yeah. So I'm assuming the next time we see this chart, both the red and the blue are going to be down considerably. That's what I'm assuming.
Yeah, they'll be down. Now, hopefully things moderate enough where we have a soft landing. And I guess there's still academic debates on whether that'll happen or not, and how disruptive the Fed's actions will be on the economy. And again, the lending standards, how willing organizations will be to lend to people, and there's not a credit freeze of some kind.
Yeah.
If it kind of moderates and it's managed well, we'll probably just see a nice little decline to the average over a period of time. But the risk is it plummets.
Yeah, because we've been talking about this since the pandemic, Tom. Remember? When the pandemic hit, we all said, okay, where's that tidal wave of delinquencies? Where's that tidal wave of collections? And it never appeared because of all the government subsidies that the payments that they had. Those kind of stemmed that tide, if you will. But now all that stuff is ending, and here it comes. So yeah.
Well, and to your point, I just saw an article today about buy now, pay later.
Mm-hmm.
People using it for groceries.
Yeah, I heard that too.
Right. Which, again, if you use credit cards to pay for groceries, it's kind of the same concept if you don't pay your balance off. So it's not a new phenomenon, but if people are justifying it because they're having a hard time affording groceries, which I think was in the article that you and I probably read together.
Yep.
Then that's a real problematic scenario, because now you've got new debt. And then we're talking about a generation that also has that student loan debt conundrum, and those payments will have to be made at some point, talking about the accommodations the government has made for people. So there are a lot of pressure points, I think, on delinquencies and charge-offs, meaning that the green that we've experienced with efficiency, which is how much we spend to make income, is going to be offset by those increasing delinquencies and charge-offs, and ultimately what we have to set aside to protect ourselves against the charge-off figure.
Yeah, indeed. Yeah. So again, interesting times. The next couple of quarters are going to be very interesting to watch, and I'm sure you're going to have your eyes on it pretty focused there, Tom. So and again, usually you share maybe a credit union or two that's doing some interesting stuff as well.
Yeah, let's talk about our top leaders. I think Sycamore. This is. Little credit union. I'm sure they don't think of themselves that way. Little credit union in Sycamore, Alabama, 47.5 million in assets now, 2,600 members, 12 employees, 1 branch, but they're killing it. They've got a score of 8.941. And across the board, they've got strong numbers, loan growth. They manage a high level of cash. So their strategy is right for their size and their complexity. They do very well. There's another one in Pennsylvania that popped up. They're a little bigger. They're 110 million, but they're number 2 on the list, and I haven't seen them that high before, out of Plains, Pennsylvania. Then you got Cottonwood Community. That's a new one I haven't seen on the top list. They're 239 million. They've got a score of 8,706. And what's interesting about them, Sycamore actually came down a little bit. Their year-over-year percent change is a negative 0.97, horror of horrors. But the other two, City Mark and Cottonwood, have increased their scores year over year. So they just keep climbing the ladder.
Good for them.
You mentioned, I'll end on this. It's a little bit of a downer, if you will. I'm not going to say names.
Okay.
But just to give you a comparative viewpoint here. There are a number of small credit unions, really tiny credit unions that definitely struggle. I think by our count, there are about 470 credit unions, give or take, that I think if they don't find new strategy, they're not going to be around much longer. And here's an example. This is a credit union in the state of New York. Their health score is 2.471.
Oh my!
Compare that to the 8 of City Mark or Sycamore. Their strength is in the capital ratio. So they actually have a plus 8% capital ratio. But all their other numbers are not good. They're not growing. They don't have their borrower penetration base is about 1%.
Goodness.
So they don't have any loans, right? So you look at what they're doing and what they are, and you think, wow, how is that gonna survive? Now they're very tiny, this particular one, but we've got some on here, 6 million in assets. It's in that same kind of dire strait. You got one down here that's about 40 million in assets. So they're not inconsequentially small. Most of them are, but some are very similar to Sycamore. And you say, if one can do it, why can't another?
Exactly. It sounds like they need to call each other and say, hey, what's going on? How can you help us? Or what's your recipe? That's what's working for you. So yeah, they need to give each other a call.
Absolutely.
Help each other out, for sure.
Yeah, but you're seeing some really good stuff and creative strategy in the marketplace right now, and people capitalizing on an opportunity, which is to make credit unions known when people are struggling. That's the best time we have to tell our story. Agreed. And that is definitely working for some institutions out there.
Agreed. And so usually my last question that I ask you, Tom, is like, what's in store for the rest of the year that can you get your crystal ball out, sir, based on these findings? I know everybody's, crystal ball is as murky as the next, but I mean, what do you see just based on these findings for the rest of the year, or even just next quarter, if you can?
Yeah, I'm looking. So one interesting thing is operating expenses. Again, that's in relation to assets. So as we see some changes in artificial manipulation in assets, and operating expenses becomes a tough metric to trust, if you will. But we're sort of moderating in that asset outflow, like I said. So operating expenses went year over year negative for the first time in quite some time this last quarter. And I've been surprised by that, because I would have thought that with inflation, wage inflation, supplies, goods inflation, and all that we would have seen operating expenses continue to creep up, meaning a negative year-over-year decline in the score. We haven't seen that until this recent quarter. My suspicion is we'll start to see a lot of those costs kind of entrenched, if you will, and we'll see, I'm sure, a number of credit unions begin to struggle with operating expenses. Delinquencies, charge-offs, lending growth challenges, if you have to tighten up, will affect your income. So I'm thinking we'll see operating expense challenges and challenges with efficiency, meaning that this lovely period of time we've had where we've got improved efficiency scores, we'll probably see that coming down, meaning we're going to start spending a lot more money to make the same dollar. Which is a challenge to be in, for sure. Yeah,
especially in the environment that we're in right now. So, all righty, sir. Anything else to add? Any final thoughts here? Or any final stats that you want to provide us before we let you get back to work?
Yeah, no, I think that by and large the industry as a whole is healthy. Most of the healthy credit unions are very large credit unions, so it's not like there are any share insurance fund risks that are incredibly concerning, like a Silicon Valley Bank. But it comes down to your individual credit union. Make sure you're paying attention and setting yourself up for long-term survivability. Some of them aren't, obviously, but that's my advice.
We hear that loud and clear, sir. Alrighty, Tom. Well, I'm going to let you get back to work. We're going to do a little walk out music for you. So appreciate the time as always, sir. The information that you provide us with each quarter is second to none, and we appreciate all your efforts and look forward to having you on the show again. Well done.
Thank you, Mike. Good to be here.
You are welcome.
Like walk back music.